Good afternoon, everyone. Jim Kruzan here with another capital market review. Today's edition, we'll talk about the fourth quarter 2020. It'll be our first quarter review of what happened in the fourth quarter of 2020. And before we begin, we'll share a couple of our disclosure documents. In essence, everything expressed here is an expression of yours truly, Jim Kruzan, and not necessarily a reflection of Raymond James, our custodian, or anyone else. As we do every quarter, we come up with a theme, something that would reference what we've experienced. And today's theme is After the Storm, Investing in 2021 and Beyond. And the reason we do these is we feel the economy matters. And as a result, we're going to look at a number of different components of the economy and the markets. We'll talk about growth. We'll talk about jobs and unemployment. We'll talk about what corporate profits look like at this point, inflation, and also interest rates. And we do this in an attempt to answer where we are today, but more importantly, where we're heading. To set our investment theme, we try to get two things right. We want an understanding of where we are in the economic cycle. For example, today, arguably, we're somewhere between recession and recovery, which is significantly different than where we were a year ago before COVID, which was more than likely late stage in what is considered the mature market. Knowing that the next stage is economic slowdown or aging. Today, we have a lot of opportunity ahead of us as a set, probably more than we would have a year ago. And the other thing we like to get right is, where is the Fed? Are they accommodative and willing to loosen or stay loose? Or are they beginning to worry about inflation or a heated economy and are willing to tighten? Today, the Fed is our friend. They plan on keeping rates lower for longer. But more on this in a little bit. Our agenda today is somewhat short and sweet. We'll spend a few moments kind of bringing us up to date on where we are with respect to the pandemic. We'll talk about the recovery and economic growth. We'll talk about both fiscal as well as monetary policy, which are both extremely large. And we will talk about equities and the benefits of diversification. And in that dialogue, we'll talk about some of the risks and some of the opportunities we see at this point as well. So let's jump right into the swim of things by talking a bit about the pandemic. So this first slide talks a bit about COVID and the US confirmed cases and fatalities. The powder blue line references confirmed cases, and the gray line represents fatalities. And as you can see, we had a huge surge. We then had a drop in both confirmed cases as well as fatalities. And then here late in the year and currently, we're seeing a swing up in both cases, both case count as well as fatalities. Now, why this is important is there is certainly a correlation between the number of deaths and cases and economic activity. Generally, as case count drops and death rates drop, economic activity increases, and vice versa. Now, sadly, we expect case count and unfortunately fatalities to continue to rise probably through April. And then we will see things revert back and we will see economic activity continue as well. As of this date of recording, we've seen a little bit of slippage in economic activity, in part because of the rising case count, as well as the reactions of local governments in terms of stay in place and restrictions. Let's talk for a moment about recovery and economic growth. This slide talks about the composite of GDP, kind of what is GDP being made of, and where exactly are we. To the left, we'll see the chart on GDP. The blue dashed line that moves left to right in an upward direction is GDP's trend line, which has been averaging about 2.5% economic growth. The dark gray line represents the actual GDP. We saw a huge drop in Q1, Q2 of last year, about a 5% drop in economic activity for Q1, a 31% drop in Q2. We then saw a huge swing in economic activity in Q3, bringing the V-shaped recovery that you see. Q4, which has not been released, will come in much weaker than what we saw in Q3. It will still be positive, but the conjecture right now is a bit more like 5%, which means that to date, we aren't anywhere close to where we were from an economic activity perspective before COVID. We still have a long way to go. And when you consider the trend line, and we're just getting back to where we were a year ago, we should be 2.5+% higher than that. So we're quite a ways away from the actual trend line. And then when you look at components of GDP, the only area that's really robust is housing. Housing is certainly less than 5% of our GDP activity, and consumer confidence or consumption is not quite back to where it was before. So we still have quite a bit of work to do in terms of the economy. When we look at unemployment or the employment situation, very much the same. We saw a huge increase in jobs over the last decade, 22 million jobs created. We saw a loss of 22 million jobs in just a 2-month period. That chart on the left-hand side is quite incredible. Effectively, in a 2-month period, because of COVID and shutdown, we lost effectively all of the jobs created over the last decade. And we've seen a rebound in jobs since April of last year. However, we're still a long way from full employment, which is about a 4% unemployment rate, and even further away from where we were a year ago, which is more like 3%. The chart to the left, I'm sorry, the chart to the right, I should say, payroll, employment loss and regained will show within various industries how they've done in terms of coming back. You'll see leisure and hospitality, which is that first section. There is still many, many jobs that need to be recovered. In other areas, like logging or mining, we've seen an increase. Looks like a negative number, but it's the inverse of that. Generally, an increase in those jobs relative to the size of what it was before. So there's a lot of work that still needs to be done with respect to the economy. When you look at unemployment as it relates to wages, that's kind of interesting as to what's happening today. And I think it also talks about what jobs are being recaptured. So what we see is the powder blue line representing wage growth. That's the average year-over-year increase in wages as it relates to the economy, not necessarily individual jobs. That actual year-over-year rate increase was more like 2.6%. And then you see the dark gray being the unemployment rate, currently at about 6.3. One thing you'll notice is as the employment rate drops and we have a loss in wages, generally it's the lower wages whose jobs get lost quicker. It's also the lower wage jobs that get hired later as well. So we have this phenomenon that's happening right now is those that have not lost their jobs, or those that are getting hired back to skilled positions. And in terms of the economy, we're seeing an increase in wage growth. That will more than likely subside. It'll normalize when we see a lot of the restaurant, entertainment, and leisure jobs coming back. But right now, most of the job growth is in much higher wage areas, which in terms of economic activity shows a skew in wage rates. CPI, or inflation, fairly benign, but it's also somewhat benign because of energy CPI. When the economy was shut down last year, we didn't see anywhere near the utilization of energy. People weren't traveling, airlines weren't flying, people weren't consuming a lot of energy, gasoline and such. Think of the GM Tech Center as an example. Nearly a full square mile. Most of the folks that work there on a daily basis have been working from home. So do you think General Motors is paying for the same type of utility usage that it does when everybody arrives to work every single day? So when we look at the little box inside the chart, and we look at November of 2020, the most recent data available, you can see one of the reasons that inflation is as low as it is energy CPI has dropped nearly 9%, both in November as well as October. Generally, over a 50-year average, energy costs have spurred a fair amount of inflation, about 4% of the nominal amount. So that's being used as somewhat of a governor. So when we look at inflation, the PCE deflator, it's 1.4%, which is somewhat benign inflation. That can change quickly if, in fact, we see a resurgence in economic activity. That's one of the things that potentially could slow the economy down. This chart talks about the sources of earnings. And there are essentially three sources. Profit margin, how much do you generally make as a percentage of what you sell? Revenue growth, how much bigger is your pie growing? And share count, how much smaller are you shrinking the number of shares outstanding? If you reduce the number of share count by 10% and you had flat earnings growth, you would report about a 10% increase in earnings per share. And you'll see over periods of time, each of the three have contributed significantly. Prior to COVID, a reasonable amount of earnings came from share count. We're now expecting to see revenue growth kind of spur earnings as well as a resumption in margin. In fact, we might even see an improvement in profit margin as companies are spending money a bit differently. Many are allowing employees to work from home longer. They've reduced the need for a lot of corporate travel. So we might actually see going forward an improvement in both margin and then also an improvement in many industries in revenues. I like this chart because it talks about economic activity as it relates to the service in the manufacturing center. And it talks about the PMI report, which is the Purchase Price Managers report, which gives an idea of economic activity in those two areas. And green is good, red is bad. It's a hot map showing activity. The more economic activity there is, the greater the growth of the activity, the darker the green shading becomes. And the weaker the activity is, the less activity we see, the more it becomes red or pink or yellow as it moves toward dark pink. And you'll see that to a large degree in 2018, we had very robust growth. Everybody essentially was green or some derivation. And then in 2019, again, late stage recovery before economic slowdown, things started to slip a bit. The economy was starting to slow. Our economic growth rates were slowing, not only here in the US, but all over the world. And then COVID hit. And in a very short period of time, everybody turned red. And now we're beginning to see various stages of recovery. When we look at the November's data, which is the only complete data we have, December is yet to be published completely, we will see the US, which is the third or fourth from the top, fairly strong economic activity. We've already reported December's numbers, also very strong. You're seeing somewhat similar strength in the emerging markets, but developed markets, think of that as Europe, still green, but less so. There are still some spotty areas that we're looking to see some improvement in core Europe, France, Italy, and Spain. But while the growth rates are different within many countries, one thing for certain is just about everybody was impacted as a result of COVID, and we're starting to dig ourselves out of that. This chart talks a bit about currency and the international equity returns. And the purpose of this is to share with you what we think will be a change this year. The last several years, the US market has certainly outperformed the international markets. And we think that may be changing. As I'm recording this to date, I will tell you that the international markets, both emerging as well as developed, are outperforming the US markets year to date, at least since January 1st of 2021. We think the reason for that is twofold. One, we think the European economies may very well come out of this thing very, very strongly. And we will see euro currencies as well as Asian currencies rebound. And we also think the dollar will have a tendency to slip. And part of the reason for that is the debt level. A lot of the other European currencies have handled COVID differently. They've spent money to support the economy, but not anywhere near the extent that we have. So we have thrown about $6 trillion of cash, almost $9 trillion total of support toward COVID, fiscal and monetary, for what turns out to be about a $2 trillion economic shortfall. That's overkill. So as a result, this should put downward bias on the US dollar, and that advantages the international securities. The chart to the left talks about US dollar strength and international GDP growth. And you'll see somewhat an inverse relationship. And what you'll notice is that when the US dollar is strong, international securities are weak. And when the dollar weakens, generally you'll see an upswing in activity. The chart to the right talks about the components of that. When you look at the return we get as US citizens buying international, how much of that comes from real growth in local currency and how much of that is currency impact? In some years, it's been half or close to half of the return comes from currency alone. And we think the weakness in the dollar, because of the debt levels this year, we will have our GDP, which will come in less than our debt service. The same thing happened last year. It's only going to be more so this year. So we expect the international securities to start performing better and may very well outperform the US going forward. This slide talks about federal finances. I alluded to this on the last slide. So if you look at the chart to the right, at the bottom, we talk about net debt or cumulative deficit. And if you look at the chart, it shows our national debt. And you will see that we ended the year at 100.1, meaning our debt level is now 100% plus of our GDP. In many years, it was much less than that. In 04, it was 40, 50% of our GDP. This thing has absolutely exploded. And our debt levels today are as high as they were coming off of World War II. In fact, that was the last time we exceeded 100%. In just a few short years, that number may very well be close to 110% of GDP. That starts to become a drag on economic growth. The debt service alone becomes a bit of a drag. Thankfully, today, with very low interest rates, it's less so. So the US government has every incentive in the world to keep rates as low as possible. Rates start to spike, it'll have a direct effect on economic activity. This chart, for that very same reason, shows what we expect to happen with interest rates. Now, by interest rates, I'm talking about the Fed funds rate or the discount rate. Same thing. It's the only rate that the government really controls. Everything else is set by auction. And you'll see over the years, those rates have been up and down. They've staircased up and stair-stepped down. Currently, if you look at those dots that are very close to the x-axis, you'll see both a brown as well as blue numbers. The blue numbers are the FOMC's year-end estimates of where they expect rates to be. The brown is market expectation. And to a large degree, both the government as well as the bond market isn't expecting much movement in the discount rate. The government has changed their approach to inflation. They've also changed their approach to unemployment. And they've hinted as recently as earlier this week that they may allow rates to stay low for a much longer period of time. So that's important because that will allow us to finance some of this debt, but it also spurs some degree of economic activity. The problem with it is, however, if we wind up in a recession and our rates are 0 to 25 basis points, it doesn't provide a lot of wiggle room to cut rates in an attempt to stimulate the economy. Let's move now and talk about equities and diversification. This is an interesting slide because it talks a bit about market volatility, which is identified at the bottom chart, as well as stock market pullbacks. And you'll generally see that volatility spikes when the markets sell off. And we saw a fairly significant spike in the VIX index, which is the volatility index, over February, March, April, during the onslaught of the drop as a result of COVID. And our VIX spiked to a point very similar to what we saw in 2008-9 during the financial crisis, although it was much more short-lived. Now, as a result, the recovery with the market in anticipation of an economic recovery eventually was also fairly quick. It's not often that way. If you look at some of these circles up at the top, which identify sell-offs, we can start with, as an example, 2008, 2009, and you'll see a sizable sell-off. The S&P dropped 56%. It dropped about 34% earlier last year. But the recovery earlier last year was very quick, surprisingly quick. Whereas during the financial crisis, peak to trough, it took over 15 months to hit bottom. And then it took many years for things to recover. So think about that when you think about how we approach our IRA investments, which is generally a large core of our clients' net worth. Bend but don't break, active loss management. We want to eliminate a lot or some of that downside risk because we're not sure how long it takes to recover. And when you're pulling money off of the portfolio to enjoy retirement, being able to recover quicker because you didn't suffer as much, to be able to reposition to those areas which are advantaged during the recovery make a huge, huge difference. This chart is called a Skittles chart, and it shows the various asset categories over a running 15-year period. And the purpose of the chart is to show that over time, assets perform and assets lag. And it's hard to pick a winner looking out into the year ahead. Last year, small cap stock did very well. We have a significant overweight in small cap, followed by emerging markets and then large cap. And then you'll look at emerging markets as being some of the worst performing areas a few years ago. But the light gray line, which represents a diversified portfolio, is performed pretty well throughout. Not the high highs, not the low lows, but consistent return with significantly less volatility. A reasonable return with a lot less volatility is what most people seek, especially when this is money that has to last over a long period of time, and it contributes to cash flow that they enjoy real time. While we just talked about stocks, it's important to talk a bit about bonds. And bonds are somewhat of a problem right now. Interest rates are super low, so you're not getting much yield. And if you remember, bonds are like a teeter-totter. Interest rates go up, bonds go down. Interest rates go down, bonds go up. So with interest rates at nearly zero, there's not a lot of wiggle room for interest rates to go down much. They may stay low, but they're not going to go down much, which means there's very little opportunity for bond prices to appreciate. And this chart somewhat shows that. The big gray bars that you see across the page show the spread of yield, what bonds were paying in various categories, how much they were paying at the highest point at the top of that gray bar, and what they're paying at the lowest point, which is the bottom of the gray bar. And then the triangle, or actually it's not really a triangle, the diamond is where we are currently. And you'll see that in the case of treasuries, over the last 15 years, a 10-year treasury was paying about 5.5% or 550 basis points. And you'll see it's been as low as, well, frankly, about where it is today. And you'll see that throughout. So it becomes very difficult to make money in bonds. And that's also one of the reasons that you're beginning to see portfolio managers, including us, start to take some positions in gold. And one of the reasons for that is gold can also be a portfolio protector, but you don't have quite the same issues that we have today in the current bond market. Let's talk about index concentration, which is an issue, and it is a huge, huge risk. The chart on the left talks about PE, or price earnings ratios, of the top 10 securities inside the S&P 500 versus the remaining securities. So the green line references the top 10 names. The dark blue or gray line represents the other 490. And look at the spike in PEs. PEs are currently 35 times earnings, something like that, close to it, which is historically high. It's about 172% of average trend versus the remaining, which is actually trading at a current PE less than, certainly less than the S&P, and just a hair above the average. So these large tech companies that exploded last year are very expensive. They also become a sizable amount of the S&P. At the right-hand side, at the top, you'll see the weight of the top 10 versus the S&P. And it's something close to 29%, call it 30%. So 10 stocks represent about 30% of the price movement. This is a similar situation to the dot-com bubble, when the top 10 represented an equivalent amount, and when technology sold off, when tech dropped as much as it did, when the NASDAQ dropped 90%, the fact that the S&P had as much concentration as it did caused the S&P to drop nearly 50%. We're watching this very closely. Unfortunately, we don't own much of the S&P. We don't own much technology these days as well. When you talk about valuations, they're very high. And you'll also notice that there's huge swings in dispersion within the S&P. Right now, the S&P is trading at well over 20 times earnings compared to a historic average of 15 and some change, with a dispersion of valuations of about 10%. The dispersion today is over 21%, which is quite high. And if we look at that kind of gray cloud that you see of dispersion, we'd have to go all the way back to just before the dot-com bubble to see similar types of spreads. So this certainly indicates that many of the tech companies, by a historic standard, might be a little bit expensive. This chart kind of proves the same thing. On the left, we see this gray line meandering across the horizon. When that gray line is above the horizon, as it's been for quite a few years, growth stocks, think of that as technology, Apple, Amazon, Facebook, etc., are cheap, and value seems to be relatively expensive. But when it breaks below that horizon, all of a sudden value stocks are cheap and growth is very expensive. The same thing somewhat happened again, 2000, 1990, as the technology stocks were rising going into March of 2000, they dipped below the horizon. Tech got pummeled, value started to step up, and value had an incredible 2-3 year period. We're suggesting as the markets reopen, value will probably outperform growth. Emerging markets, international securities just look really cheap. They look cheap when you compare them to their long-term average. They look cheap when you compare them to their PE. Emerging markets are trading at PEs today, which are half their historic levels. With a weakness in the US dollar, we expect to see returns coming in from these areas that would look much better than the US market. And year to date, while it's not a ton of time, certainly is suggesting that. Because interest rates are near zero, it's very, very difficult to invest in the bond market without accepting other risks. This chart shows various types of bonds, ranging from the left-hand side, which are US Treasuries, USTs, all the way out to convertibles, European high yield, US high yield, and such, and then everything in between. The x-axis is a correlation to the S&P as we move left to right. Bonds react more like stocks. And then the y-axis would be hedge and adjusted yield. So how well does it hedge against the stock market? So you'll see treasuries are a great hedge, but there's very little yield. So you're not making much for the hedge. And then as you go out, if you want yield, 3, 4, 5, 6, 7% yields, you're getting absolutely no hedging quality. So at this point, we're looking for other alternatives to hedge against equity risk. As it looks like interest rates, not government rates, but 10-year treasuries and corporates, you may very well see interest rates start to rise a little bit. We're looking at kind of floating rate, which is kind of in the middle of that group, which might get us a bit better yield improvement and reduce some of the negative correlation that you see with bonds. Well, that was a quick run through of the economy, the equity markets, the pandemic, and certainly the bond market. Hey, I just want to let you know we're bigger and better than ever. A team of 14. We're looking at hiring a few more team members over this next quarter. We're open for business and would love to sit down with folks that you think could benefit from having a conversation with us. And we would certainly offer the opportunity to take a look at what they're doing and offer a second opinion. Look at performance and allocation and strategy and pricing. So just keep that in mind. We use what we call our evolutionary wealth process to walk a new client through our system, starting with discovery interview and ending with maintain discipline, which is just a cadence of regular reviews and meetings to make sure everything is on pace. If you have any questions, by all means, reach out to us, either at our phone number, 810-593-1624, or you can visit us at www.kaydanwealth.com. With that, I want to thank you. Happy New Year. We will do this again in another 3 months. And at that time, that'll coincide with essentially the first 100 days of the new administration. And we'll see how the markets have reacted and tolerated some of those moves as well. So with that, take care, be safe, and we'll talk to you again real soon.